My rent is $1,500 a month. A house in my area starts at $350,000. I've run the math, and it feels genuinely impossible. What's the down payment you've been calculating? 20%, so $70,000. That's the traditional recommendation. It's not the only path. At my savings rate, it would take me 14 years to save $70,000. At your current savings rate, yes. But there are three things wrong with that calculation. What three things? The down payment target, the savings rate, and the account type. All three are probably not optimized for this goal. Change any one of them, and the timeline changes significantly. Change all three, and you're looking at a completely different picture. Walk me through it. Let's start with the number people spend the most time arguing about. The 20% myth. Home ownership feels impossible to more Americans right now than at almost any point in recent memory. The Federal Reserve's survey of consumer finances tracks homeownership rates by age cohort, and the data shows that homeownership among adults under 35 has declined significantly over the past 2 decades. The reasons are multiple: rising home prices relative to wage growth, student loan debt affecting qualifying income, geographic concentration of jobs in high-cost markets. But one of them is also this: the belief that the only legitimate path to homeownership runs through a 20% down payment, which has turned a manageable goal into what feels like an impossible one for a generation of renters.
The 20% down payment recommendation exists for a specific and legitimate reason. When a borrower puts down less than 20% of a home's purchase price, most conventional lenders require the purchase of private mortgage insurance, commonly known as PMI. PMI is a monthly insurance premium paid by the borrower that protects the lender, not the borrower, against the risk of default. It typically costs between 0.5 and 1.5% of the loan amount annually, which on a $280 0-0 loan translates to approximately $117 to $350 per month added to the mortgage payment. PMI is eventually removable once the loan-to-value ratio falls below 80% through a combination of payments and home appreciation. The 20% down payment eliminates PMI from day one.
But 20% down is not the requirement to purchase a home. It is the threshold above which PMI is not charged on a conventional loan.
FHA loans, mortgages insured by the Federal Housing Administration, a federal government agency, allow qualifying first-time buyers to purchase with as little as 5% down. On a $350,000 home, 3.5% is $12,250. That is not a trivial savings target, but it is in an entirely different category of accessibility than $70,000. FHA loans do charge their own form of mortgage insurance, called MIP rather than PMI. But for buyers who would otherwise spend years or decades accumulating a 20% down payment while paying rent, the total financial picture of buying sooner with a smaller down payment and mortgage insurance may be more favorable than waiting significantly longer to avoid the insurance cost.
Conventional loans also offer low down payment options. Programs backed by Fannie Mae and Freddie Mac allow qualifying first-time buyers to purchase with 3 to 5% down, with PMI that can be canceled once the equity threshold is reached. Many states and municipalities offer first-time homebuyer assistance programs, grants, forgivable loans, or below-market rate second mortgages that can cover a portion of the down payment or closing costs. The CFPB maintains an online resource that helps buyers identify what programs are available in their specific state and county.
The total costs of purchasing a home extend beyond the down payment, and this is where many first-time buyers are surprised. Closing costs. The fees associated with completing the mortgage transaction, including lender origination fees, title insurance, appraisal, inspection, and prepaid taxes and insurance, typically range from 2 to 5% of the loan amount. On a $350,000 home with a $12,250 down payment, closing costs could add $8, $500 to $17,000 to the required cash at closing. Most buyers should plan to have their down payment plus 2 to 3% of the purchase price available in liquid savings when they are ready to buy.
Now let's talk about optimizing the savings itself.
The savings account type matters significantly for a medium-term goal, like a home purchase. Money that will be needed within 1 to 5 years should not be invested in the stock market. The risk of a market decline in the years immediately before you need. The money is too high. A high-yield savings account, an FDIC-insured savings account offered by online banks at interest rates significantly above the national average for traditional savings accounts, is the appropriate vehicle. As of recent Federal Reserve rate cycle data, high-yield savings accounts have offered rates between 4 and 5% annually during high interest rate periods, compared to the 0.01 to 0.5% commonly offered by traditional bank savings accounts. On $20,000 saved in a high-yield account at 4.5%, the annual interest earned is approximately $900. Money that a traditional savings account would not have produced.
Ramit Sethi, in I Will Teach You to Be Rich, makes a point about the rent versus buy calculation that is worth addressing directly. Renting while saving for a home is not throwing money away. It is buying time and flexibility while building toward a specific financial position. The decision to buy should be based on whether buying makes financial sense for your specific situation, your income stability, your geographic flexibility, your expected tenure in the home, the local rent versus own cost comparison, rather than on the cultural assumption that homeownership is always superior to renting. A buyer who purchases before their financial foundation is ready often ends up house poor. Technically a homeowner, practically unable to cover the costs that ownership inevitably produces.
The practical savings plan for homeownership is straightforward once the target is clear. Identify your actual target. Down payment plus closing costs plus a small reserve for immediate post-purchase expenses. Identify a realistic monthly savings amount. Open a dedicated high-yield savings account named specifically for the goal. Automate a monthly transfer. Track progress quarterly. Revise the monthly amount upward whenever income increases or an expense is eliminated.
The goal is not just the down payment. The goal is buying at the right moment with the right financial foundation beneath you. A stable income, a funded emergency fund that will not be depleted by the purchase, a manageable debt-to-income ratio that qualifies for favorable loan terms, and enough post-purchased liquidity to handle the expenses that ownership always produces in the first year.
The house is achievable. The timeline depends on how clearly you define the actual target and how deliberately you build toward it.
So 20% down is ideal but not required. FHA loans go as low as 3.5% with mortgage insurance, and state-level assistance programs can reduce the cash required even further for qualifying first-time buyers. High-yield savings account for the down payment fund. not the stock market. The timeline is too short for market risk. High yield savings is safe and earns meaningfully more than a traditional savings account right now. And I need closing costs on top of the down payment. 2 to 5% of the loan. Always budget for both. Buyers who only save the down payment often get surprised at the closing table. My actual target with a 3.5% down payment on $350,000 is around $25,000 to $30,000 total, which at $250 a month automated to a high yield account is a 9 to 10 year goal, or faster if income increases. That's still long, but it's not 14 years and it's not impossible. Nothing worth building is immediate, but nothing impossible is worth planning for either. This is neither.